A grocery store looks like one of the simplest businesses in America. You buy food from suppliers, put it on shelves, and sell it to customers. Simple, right? Not even close. A grocery store can generate hundreds of thousands of dollars in weekly sales, yet the amount left as profit can be surprisingly small. In fact, the Food Industry Association reports that the average net profit for food retailers was just 2.1% in 2025. The average supermarket generated about $668,377 in weekly sales that year. So where does all that money go? And if grocery stores make such thin profits, why are companies still fighting so hard to open stores, expand locations, and win your weekly shopping trip? That is where the economics of a grocery store gets interesting. At the most basic level, a grocery store is selling convenience. You could buy flour directly from a manufacturer. You could visit a farm for vegetables. You could order meat from a producer. But most people don't want to manage dozens of suppliers just to make dinner. The grocery store solves that problem. It puts thousands of products in one place, close to where people live, and makes them available when customers need them. And that creates the first important economic advantage: frequency. People don't need to buy a new television every week. They do need food. A family may visit a grocery store repeatedly throughout the month, which gives the retailer something incredibly valuable: recurring demand. But recurring demand doesn't automatically mean huge profits. Imagine a customer walks into a grocery store and spends $100. That $100 is revenue. It is not $100 of profit. The store first has to pay the suppliers for the products. Then there are employee wages, rent or property costs, electricity, refrigeration, insurance, maintenance, technology, payment processing fees, transportation, advertising, cleaning, security, and plenty of other expenses. And some products never even make it to the checkout. They expire. They get damaged. They get stolen. They are marked down. Or they simply don't sell. This is one of the biggest differences between a grocery store and a simple online business. A grocery store has to physically hold inventory. And inventory costs money. Think about a gallon of milk. The store doesn't just need to buy the milk. It needs refrigerated space, employees to receive and stock it, electricity to keep it cold, shelf space to display it, and a system to make sure it gets sold before it expires. That's why a grocery store isn't really just a food business. It's an inventory management business. The goal is to keep enough products available so customers don't leave empty-handed, without buying so much that products sit around and become waste. And that balance is extremely difficult, because customers expect abundance. If you walk into a grocery store and see empty shelves, you may simply go somewhere else. But if the store constantly overorders, unsold inventory starts eating into profit. This creates a strange trade-off. More inventory can improve customer satisfaction, but more inventory also increases the amount of money tied up in the business. Now let's look at how the revenue actually works. A grocery store makes most of its money from selling products. But not every product plays the same economic role. Some products are there because customers specifically want them. Others are there because they encourage customers to visit. And some products can help the store make better margins than others. Fresh departments are particularly important. According to FMI, fresh foods accounted for 42% of total grocery sales in 2024. Think about produce, meat, bakery, prepared foods, and other fresh categories. These products can differentiate one store from another. A customer might visit because they like a particular bakery, prepared food section, or produce selection. But fresh food creates another problem. It is perishable. If a grocery store sells a packaged product today, that product may still be useful weeks or months from now. A bunch of bananas doesn't have the same luxury. So the store is constantly making a prediction. How much will customers buy tomorrow? That prediction determines whether the store makes money or throws money away. And this brings us to one of the most important concepts in grocery economics: turnover. A grocery store generally wants products moving through the system quickly. Buy inventory, sell inventory, collect cash, reorder, repeat. The faster that cycle works, the more efficiently the store can use its space and working capital. And scale makes this even more interesting. A large grocery chain can negotiate with suppliers across hundreds or thousands of stores. It can spread technology, advertising, distribution systems, management, and purchasing operations across a much larger sales base. That's an economy of scale. The same corporate system can support many stores instead of one, but bigger sounds better. Here's the problem. A bigger grocery operation also becomes more complicated. More stores mean more employees, more refrigeration, more transportation, more inventory, more equipment, more opportunities for theft, damage, mistakes, and supply chain problems. So scale doesn't eliminate problems. It changes the economics of the problems. Now imagine two grocery stores. Store A has strong customer traffic and keeps its shelves moving. Store B has the same building size but much lower traffic. Both stores might have refrigerators, lights, checkout systems, managers, and basic operating expenses. But Store A can spread those fixed costs across more sales. Store B cannot. This is why location matters so much. A grocery store needs customers close enough to visit regularly, and those customers need to come back. Because grocery retail depends heavily on repeat behavior. If a customer buys groceries from you every week, that customer is far more valuable than someone who visits once. And this is where loyalty programs, discounts, private label products, personalized offers, convenient locations, and good shopping experiences become economic tools. They're not just marketing, they're attempts to increase customer frequency and retention. A store doesn't necessarily need every customer to spend dramatically more. Sometimes getting a customer to return one more time is extremely valuable. But there is another surprising part of grocery economics. A store can make money from the products it sells without earning most of its economic value from the product itself. For example, retailers can generate revenue through advertising and retail media. Brands want access to shoppers. A cereal company doesn't just want its product sitting somewhere inside the store. It wants customers to notice it. So the retailer can sell promotional placement, digital advertising, sponsored search positions, and other forms of access to its customer base. The store has something valuable beyond shelf space, customer attention, and that's an important hidden asset. The grocery store knows what millions of shoppers are searching for, buying, and comparing. That information and access can become part of the business model. Then there are private label products. Instead of selling only national brands, a retailer can sell products under its own store brand. The economics can be attractive because the retailer controls more of the product relationship and can use private labels to offer customers a different price and value proposition. It also creates something strategically important: switching costs. If shoppers become loyal to a store's private label products, they may have another reason to keep returning. But grocery stores operate in one of the most competitive retail environments in America. Customers can compare prices quickly. They can shop at supermarkets, warehouse clubs, discount stores, supercenters, convenience stores, farmers markets, and online platforms. And consumers don't treat every grocery product the same. They may be extremely price sensitive about milk or eggs, while caring much more about quality, freshness, or convenience in another category. That means grocery stores constantly manage a pricing puzzle. Lower the price and you may attract more customers. But lower the price too much and your margin disappears. Raise the price and you may earn more per item. But customers may switch to a competitor. So the real question isn't, what price makes the most money on this product? It's, what price produces the best combination of customer traffic, sales volume, margin, and long-term loyalty? That's a much harder question. And now we reach the number most people misunderstand: profit. Suppose, purely as a hypothetical example, that a grocery store generates $1 million in revenue. That does not mean the owner made $1 million. Not even close. If the store eventually produced a 2.1% net margin, the hypothetical net profit would be about $21,000. That is only an example, using the industry's reported 2025 average margin as a reference point, not a claim about a particular store. FMI reports the 2025 average net profit for food retailers at 2.1%. This is why grocery retail is often described as a volume business. You don't necessarily need enormous profit on every product. You need a huge number of transactions, efficient operations, and enough customer traffic to make the economics work. And this creates another counterintuitive insight. A store can be busy and still struggle financially. Imagine hundreds of customers walking through the doors. If labor costs rise, refrigeration becomes expensive, inventory gets wasted, theft increases, payment fees grow, or the store has to discount products heavily, revenue can look impressive while profit remains weak. In 2025, FMI reported that credit and debit cards represented 81% of food retail sales, and noted that swipe fees directly affect profits. The same industry analysis also identified theft and fraud as major challenges for retailers. So every transaction has economics behind it. The customer sees a checkout receipt. The retailer sees a chain of costs. And there is another cost becoming more important: online fulfillment. For years, the grocery store was basically a physical destination. Now the customer can open an app, choose products, and expect the order to be picked, packed, and delivered or prepared for pickup. Convenience sounds great, but convenience costs money. Someone has to select the products. Someone has to package them. Someone has to move them. And sometimes someone has to deliver them. So online sales can create more revenue without necessarily creating the same profit as an in-store transaction. This is one of the biggest trade-offs facing modern grocery retailers. FMI and NIQ reported that online grocery sales contributed close to 75% of total grocery dollar growth in 2025, while projecting U.S. online grocery sales to reach $452 billion by 2028. The future, then, isn't simply online versus physical stores. It's both. A customer might discover a product online, compare prices in an app, visit the store for fresh food, and then order household products for delivery. The grocery retailer increasingly has to serve the same customer through multiple channels, and that creates an interesting economic question. Does digital make grocery shopping more efficient? Sometimes. But it also creates new costs and new competition. Another major risk is the supply chain. A grocery store depends on farmers, manufacturers, distributors, truckers, warehouses, energy, labor, packaging, and transportation. If something goes wrong upstream, the retailer can face higher costs or empty shelves. Weather can affect crops. Transportation problems can delay products. Animal diseases can affect meat and dairy supply. Trade policies and tariffs can affect costs. FMI reported that about 90% of surveyed food retailers and suppliers experienced negative impacts from international trade and tariffs in 2025, while 2/3 of food retailers cited supply chain challenges. And here's the uncomfortable part. A grocery store cannot always simply raise prices enough to cover every higher cost, because competitors are watching. If one store raises prices aggressively while another holds prices lower, customers have a reason to move. So grocery retailers constantly balance three things: price, availability, and profit. Push price too high, and you risk losing customers. Push price too low, and you risk losing money. Buy too little inventory, and customers see empty shelves. Buy too much, and you create waste. Hire too few employees, and service suffers. Hire too many, and labor costs eat into margins. Open more stores, and you gain scale. But you also increase complexity and capital requirements. That's the grocery business in one picture. Almost every decision is a trade-off. And perhaps the biggest misconception is that grocery stores make money because food is expensive. The economics are more complicated. The store wins by coordinating thousands of products, thousands of customer decisions, suppliers, employees, buildings, trucks, refrigerators, checkout systems, digital platforms, and inventory decisions. The customer sees shelves. The business sees a constantly moving financial system. And that's why the grocery store is such an interesting business. It sells products people need repeatedly. It has massive potential sales volume, but competition keeps prices under pressure, while operating costs keep pulling money away from the bottom line. The real advantage isn't simply charging more. It's becoming better at the entire system. Buy efficiently. Price intelligently. Keep inventory moving. Reduce waste. Increase customer loyalty. Use store space efficiently. Build scale where scale actually helps. And create additional revenue from assets like private brands, advertising, data, and digital channels. Because in grocery retail, a tiny improvement repeated across millions of transactions can matter more than a huge profit on one sale. And that leads to the biggest economic lesson. A grocery store isn't really a business of selling food. It's a business of managing volume, frequency, inventory, and efficiency at the same time. Revenue gets attention, but the real game is what survives after every cost has been paid. So the next time you walk through a grocery store, don't just look at the products. Look at the business behind the shelves. Every item has a cost. Every empty shelf has a consequence. Every discount has a purpose. Every customer visit has economic value. And every wasted product is money that can never be recovered. That's the anatomy of a grocery store. If you enjoyed breaking down the business behind everyday companies, subscribe to Business Anatomy, because the next time you see a simple business, we'll look underneath the surface and find out where the money really goes.